Welcome to the part 3 of the options trading strategies video series. So we are still in the call options segment, which is the part 2, and this has been divided into the current part 3, in which we'll be covering about naked call options writing. So in this particular part, I'll be giving you an overview of what is naked call options writing, that is selling options first. Then I'll be taking you through the basics of this strategy and how it is done. I'll also be showing you two most important factors that influence this call writing strategy. We'll also be taking a look into break even point, risk and reward profile of this strategy, along with strike price selection, that is in the money, out of the money, or at the money option strike prices, and some common mistakes to avoid. So this part is more suitable for a retail trader. This is not for a professional full-time trader, because in this particular part, I'll be showing you why you shouldn't be getting into the business of writing any sort of options without hedging it properly. So let's get started.
In this channel, we talk about trading, investing, and market analysis to help you become a better investor and trader. So if you are new here, consider subscribing.
So I'll begin this part by explaining you the basics of call writing, or rather short selling call options. Now, let me take an example of a stock, Reliance. Reliance actively trades in NSE and BSE segment. So let's say you don't own Reliance and you still go and sell the call option of Reliance first. What you're essentially doing is that you're writing short selling naked calls of Reliance without actually owning the stock. So in case you don't understand what is writing or what is buying an option or what is a call option or a put option, just refer to the part 1 and 2 that has already been released so that you can understand this part better. So basically there are two ways that you can write calls. One is the naked call writing part that I just explained, and other is the covered call writing, which I'll be taking up in subsequent parts. There are many other ways to do it, but those strategies I'll be discussing at a very later stage. So let me put it first that naked options writing, or short selling options as you may call it, it is one of the riskiest option strategy that you can execute. Now why I've taken up this video is because there's a huge propaganda about writing options that goes on many mediums. There's a false hope that is given that this strategy can be used to generate regular income from market. While it is partially true that it can be done, there are a host of circumstances that you have to consider, especially the risk that you are undertaking. So the reason why I said that this video is more relevant to retail trader is because a professional trader usually understands the risk profile of an option strategy better than that of a retail trader. And in this video, it is my attempt to make retail trader cautious about selling options because of the risk profile that is completely skewed against him. So again, this part is more theoretical because I want to come to the common sense part of writing options. And this part will essentially be forming a building block for the many call option strategies that I'll be covering in the later parts. So the first thing that is said about writing options is that due to time decay, you can actually make a lot of money because most of the options expire worthless. So whenever someone tells you that most of the options expire worthless, let me tell you they haven't done their homework well, because if you go to Journal of Finance and read some papers on the research papers on options, you would find that this is clearly not true. The chart that is often shown is this chart, that is impact of theta, that we discussed in part 2, that as time progresses, the value of options moves towards zero. So this is theoretically true. Towards the end of the video, I'll be again showing you this chart and I'll be putting out some data so that few things are absolutely clear. So one more widely held misconception is that professional traders sell naked options a lot. Well, let me tell you, I'm a professional trader, and in case I execute 1,000 trades hypothetically over 5 years, I'll only execute one or two trades that will be about selling naked options. So I can't speak for all professional traders, but I started my career in market as a retail trader, and now I do this full time. So which is why I was actually lucky in my trading career that I never got into the business of writing options. I've seen many traders lose their entire capital just because of writing options without knowing the underlying risk. So while professionals do write or do sell a lot of naked options, they do so by hedging their positions. I don't think any sensible professional trader goes into the market writing options without hedging their bets. So option sellers actually, or people who write options, or in case you are doing this currently, you need to be aware of time remaining for expiration. Why I put up this point? I hope you have heard about implied volatility in option. Again, this was covered in part 1 or 2. So the time remaining, let's say there is 10 days to options expiry. Well, you know what? If implied volatility in these next 10 days begins to spike up, then a lot can go wrong when you're writing options, which you might not be aware as of today. So I hope this video will actually put out the risk profile for options writing in general, and it will help you assess the risk first before trying to determine what sort of profit you can make out of this strategy. And this is something I always emphasize upon in any video that I do. The number one rule for any trader or investor has to be to save money. Everything else comes later, whether it is profits or anything you want out of market, everything comes later. The first rule that you have to keep in mind is don't lose your capital. So this chart I'll be showing you towards the end, and then I'll completely leave it up to you to draw a conclusion out of this video. So I'll give you two scenarios here. One is for option buyer and one is for option seller. That is one trader who goes out and buys option, that is buys a call option or put option, and another trader who goes out and sells option first, who's basically an option writer. So if you're a buyer of option, 90% of money that you'll make in just 10% of trade. Why it's so? Because that is the nature of trend trading, or that is the nature of trading in general, that you're successful only 20 to 30, or let's say 40% of time. If you're trading futures and equities, your success rate is somewhere between 35 to 45%. But when you're trading options, that success rate actually comes down to 20 to 30% just because of time decay. And when you're writing naked call options or even put options, 90% of money you will lose in 10% of trade. So look at the stark difference here. When you're an options buyer, 90% of money that you make will come from 10% of trade. And when you're an options writer, 90% of money that you've made, you will lose in just 10% of trade. That is, in case you're not careful, in case you don't know what is the risk. So I'll just put it out this way. Let's assume a trading sequence for an options buyer and options writer. So an option buyer would typically make a small loss, again a small loss, then a small win, then a small loss, so on and so forth. And then there will be this big win that will come because he's an options buyer, and that will actually cover up for all the small losses that have taken place. Now look at the trading sequence of an options writer. An options writer is going to win a lot. The reason being that time decay is always on his side. So he'll be winning small, again he'll be winning small, then there'll be a small loss, then there'll be a big loss. This big loss will actually take away most of the winnings, and at times much more. So I hope you can see the difference. An options writer usually is successful 80 to 90% of the time. That is why it is such a huge strategy in terms of propaganda that happens. People who are selling subscriptions or people who are giving you tips to write options. The reason why that is so successful is because 70 to 80% of the time their trades actually do make money. But I don't think even they understand what the risk is of writing options, especially now that weekly options have been introduced for Bank Nifty. The kind of propaganda that goes around that people should write options on expiry day. I seriously feel sorry for the traders who do this, because they don't understand what they are doing. and the risk profile is completely skewed against them. So please do keep this in mind while writing options. You maybe write 70 to 80% of the time and make some small money, but this 10% of the time you will lose so big that it is going to take away most of your early winnings and probably a lot more. And let me, at this stage, I do feel some of you would be thinking that this is not true. Let me just explain this mathematically to you. So this is the break even point section that I put out for all option videos. So a break even point is nothing but a stage where your option trade would actually start turning profitable. In this particular case, that is of naked call writing, break even point would be a place where your options trade would actually start losing money. So a break even point actually I have represented in this risk profile chart. So in this particular example, we are assuming that Nifty is trading at 10,500 spot, and the 10,600 call that we are going to short sell is trading at 50. So the break even point for this strategy, assuming that you have short sold 10,600 call, would be 10,650. That is, if Nifty at the point of expiry stays below 10,650, you would get to keep this entire 50 rupee premium. So the break-even point is calculated as strike price plus premium received for this naked call options writing strategy. So this is the risk profile chart of this particular strategy in case you're writing options. I've taken 28 days to expiry, which is a typical cycle. Some months it is 24 days, at times it is 30 days. It depends on how the calendar or the last Thursday day is placed on a calendar. So the Nifty spot is at 10,500, option strike is at 10,600. It is 28 days to expiry. The premium is rupees 50. So when you write a naked call option, this is the premium that you have received. In this particular case, assuming the lot size of Nifty is 75 into the 50 rupee premium, so you receive 3,750 per lot for naked call options sold, or that is a call options short sold for Nifty. Again, remember that the break even point is 10,650. That is the strike price plus premium received. So this becomes your net profit. That is 3,750 per lot. Now the maximum risk for this strategy, theoretically, it is unlimited. The unlimited part is actually not true unless and until you have some seriously negative event that happens in the market. But let me just show you the realistic risk that you carry while writing the option. So the net premium that we received, or net money that we received for one lot, was 3,750. So if Nifty expires above 10,650, which was the break even point, your net loss is 720 per lot. If Nifty expires at 10,780, your net loss is 9,900 per lot. If Nifty expires at 10,900, your net loss is 18,900 per lot. Let me not go at 11,000 and 11,400 because that I've just put out for illustrative purpose. Why these 3 points I'll focus upon is because it is very natural for Nifty to move along about 3 to 4% in a month, because that has been the historic range. So if Nifty strike price, that is the break-even price, is at 10,650, while Nifty is at 10,500, you get a lot of months where Nifty easily moves up 2, 3, 4%, and 10,900 is certainly within the reach. Look at the current market scenario that we are in. Every week Nifty is easily moving 3, 4, 5%. And being the major index, it is not unthinkable that a Nifty spot cannot go from 10,500 to 10,900. That is just about 3.8%. That is doable. Now, the first question that comes to mind is, why would someone wait till 10,900? He would square off the position as soon as Nifty gets above the break-even point. Well, that is not how trading works. This works on paper, but in case you have opened the position, there is something called as hope that kicks in. And as a trader, when you take a position and that starts going against you, the first thing that a trader starts doing is he hopes that his position turns into profit. And this is where the trap of entire option writing comes into picture. Because when you start getting into this sort of thinking that you're hoping for a trade to turn into profit, then anything can go wrong. Another reason that I want to give is gap opening. Who is to say that at 10,500 Nifty cannot open at 10,800? And at that time, volatility would be so high that this loss would be much higher. So for every lot that you have written, that is naked call option that you have opened, you receive 3,750 as premium, but on a realistic basis, you stand to lose about 19,000 per lot. That is almost 5 times more. And this data is as of low volatility environment. Towards the end, I'll take you through an example where I'll show you what happened in September when markets were falling, and there were a lot of traders who got trapped by writing options. It was very evident even on social media, in case you are on that medium. So it is not unthinkable. These things happen very, very frequently. I've also seen that while this happens very frequently, partly the reason for this is because the strike price selection, instrument selection of retail traders, especially, is completely wrong. Now, as an options writer, you need to be careful about three things. One is selection of instrument, direction of trend, and timing of trade. If you're wrong in either of these three, then you're setting yourself up for huge losses. Remember one thing, time is your friend. Yes, time decay works in your favor. As options lose money, the premiums that you get, you tend to keep them in your account. But you also need to remember one thing, that if your instrument selection is wrong and the direction of trend is wrong, then you are going to land yourself into trouble. Now, what I mean by this is there are some instruments which are less volatile than others, and those should be preferred as an options writing instrument. Similarly, the importance of trend cannot be underestimated here. So let's assume that you are into a bull market, a very strong bull market, and you go about selling naked call options. How do you think that would work for you? You are essentially moving in against the direction of the trend, and that will simply make you lose a lot of money. Similarly, consider these times as market is falling. In case you go and write naked put options, how that would work for you? Again, you are going to take huge losses because the volatility is so high, and you are seeing a rapid movement happening in put options. In case you write put options, you are just going to undertake losses. So your selection of instrument becomes extremely crucial along with strike prices. So one common mistake that I've seen traders make is they start writing in the money call options. Now that is you should not be doing that, because what happens is, don't forget, in the money call option actually has intrinsic value and time value. It is only out of the money call options which have only time value, and as time lapses or as option expiration date nears, this time value essentially tends to become zero. One more thing that you need to keep in mind is that it's not true that all options expire worthless. You should refer to a lot of research papers in Journal of Finance where it is said that almost 40 to 50% of options expire with some value at the point of expiration. So this whole idea that most of the options expire zero, that is clearly not true. In our particular market, if you still want to write options, or you're good at it and you're been doing it at a consistent basis, the instrument that you need to stick to is only Nifty 50, because it's not that volatile instrument when you consider it against Bank Nifty or some individual stocks. Even the frequent gaps that I was talking about, these can cause options to move violently, especially when implied volatility, that is IVs, expand. So in Nifty, this is still limited. And in case you want to undertake this strategy of writing options, or you have a successful method of doing so, stick with Nifty 50 and stick with out of the money option. One more thing that I want to focus upon is the psychological aspect. The two, three things that you have to consider is that psychologically, whether you can handle having written option position open in your account. Now, the reason I say so is when you first think of it, it does not seem that odd, and you do feel that you can handle this situation. But as you open up the position and the market closes, only then you would know whether you're suitable for this particular strategy or not. Do not forget that large or adverse moves do happen very frequently in stock market, and whenever these moves happen, if you have written on the wrong side, then you are potentially exposed to huge losses. So do keep in mind two things: one, whether psychologically you can handle this strategy or not, and second, whether you can set aside the margin money that is required for writing options. Without these two, I would urge you that just walk away from writing naked options, because there are many strategies that we'll be covering which are much easier on the risk side and much easier on the psychological side as well. So please be honest to yourself and do assess whether you are suitable for such strategies or not. Personally speaking, I don't write options at all, because I don't like the whole uh, idea of such a risk profile chart where I get so little and I risk losing so much. Again, this comes down to common sense and nothing else. So I'll just move to the strike price selection part again, where I highlighted that out of the money options for this particular strategy actually gives you the most comfort when it comes to overall risk. So take a look at, I've highlighted this portion here, that is Nifty 10,600 spot level. So this is out of the money put options, and this is out of the money call options. So the call option for 10,700 has a premium of 70, 10,800 has a premium of 34, 10,900 has a premium of 14, 11,000 has a premium of 6. So this is what I've mentioned here, and 11,100 call option has a premium of 3. So the first thing that a trader thinks about is, with Nifty at 10,600, what are the odds of Nifty moving to, let's say, 11,000 or 11,100 with just 10 days to go? And why they think like this is that this 14, 6 and 3, these three premium values seem extremely attractive, and most of the times you will hear that this 14 would go to 0, 6 would go to 0. That is why you should be pocketing this 14 rupees, 6 rupees and 3 rupees premium. While this is partially true that quite often Nifty does not go from 10,600 to 11,000 with just 10 days left, unless and under there is some strong momentum or event that takes place in the market, but the possibility always exists. One more thing you remember, that in order to profit from this 14, 6 and 3 premium, you will have to write huge quantities. Now, assuming that the lot size is 75, but for the ease of calculation, I'll assume that lot size is 100. So with one lot size, if you write a 10,900 call option, the net premium you receive is 14. That is 1,400 per lot only. So in case you have to profit 30,000, 50,000, 1 lakh, 2 lakh or 3 lakh, what you have to do is you'll have to write huge quantities of this 10,900 call option or 11,000 call option. Now, in my opinion, this is where maximum participants get trapped, because that one event when Nifty will move from 10,600 to 10,900 or 11,000, this premium of 14 or 6 would become 200 and about 100. Now just imagine the losses that you will undertake just to pocket this 14, 6 or 3 rupee premium. Again, people who do this would say that this is extremely safe and Nifty does not move that much and this is easy money to be made. Let me tell you, they are horribly wrong. There are countless accounts where people lose their entire savings just because of this type of thinking. Again, I will just put out one thing. It is not it is a matter of common sense here. To get this much, you cannot risk this much. Now, this is what basic math has taught me, that I want a risk profile where I lose little and make more. You cannot attain financial freedom, or you cannot get extremely rich unless and until you're this extremely successful professional trader by just making this much money and you stand to risk this amount. So I'll just take you back to this example to illustrate my point. So with 10 days to expiry, the premium that we received is 1050. What I've done is I've written 10,900 call option, premium is 14. So 14 multiplied by 75 is 1050. So with 10 days to expiry, with Nifty at 10,600, with 10,900 call option at 14 rupee premium, I received 1050 for one lot. Look what happens. At 10,960, just about 300 points away, you stand to lose 3,500 per lot. At 11,080, you tend to lose 13,000 per lot. At 11,200, you stand to lose 22,000 per lot. Again, let me just limit myself to first three strike prices, because odds of Nifty moving 7 to 10% are still fairly low. But what are the odds of Nifty to move 2.7%? What are the odds of Nifty to move 3.7%? And what are the odds of Nifty to move just 5%? If there is some major event, and it's not that this has not happened in the past, if Nifty moves 4.8% or 3.8%, you stand to lose 13,000 per lot and you received only 1,000 per lot. In this particular case, you stand to lose 22,000 per lot, whereas the premium you received is only 1,000 per lot. This is about 9 times more. This is about 19 times more. So please do the math here. It is not unlikely that this does not happen. I know people say that this happens very rarely, but again, I'm lucky that we are into times where this is happening so frequently that people cannot say that this is an aberration. This happens, and this happens so frequently that over the past 7 months, if you have received 1,000 rupee per lot for whatever you have sold, it just takes 1 month or one 10-day interval to wipe it out completely. And look, whatever money goes, that is fine. Money can be brought back. People do get capital from somewhere, but what about the psychological damage? The psychological damage when this plays out against you is absolutely huge, and I cannot quantify that. Let me tell you once more that I am not scaring you from writing options. I'm just showing you the pitfall of not knowing the risk. There are still some people who do it, and they do it to perfection. But for retail traders in general, please think twice what you are making and what you are risking. As a common person, as an average person just like you, let me tell you, I will think 100 times before I make this little money for this amount of risk. So please think again. So continuing with the previous example, like I showed you, you stand to lose 11 to 12 times and 20 times. The point that I was trying to make is that mathematically this strategy is not sustainable. And 1 month losses will actually wipe out months of option writing gains, unless and until you are lucky that you miss out on that 1 month that this is going to happen. But like we say, trading is all about discipline. It is all about following a process day on day basis. So it is quite unlikely that you are going to get that lucky that in that particular month where things are going to go against you, you would be out of the market. So again, my whole point is not to scare you, but please think again of the risk profile chart. In case you are still comfortable, please do so at your own risk. But my point is just think again. Let me now take you to the weekly option strategy segment, especially since the Bank Nifty options were introduced, that is weekly options. Now, there's been this strategy that you can write Bank Nifty weekly options every week and gain from it on a consistent basis. I am not here to ridicule any strategy, but I'll just show you what happened in October. Now, this Bank Nifty option, that is put option 25,300, opened at 391, and the last traded price you can see is 100. But it sounds nice that you can write this position at 391 and eventually ride it to the low point, that is at 1. But in between, look what happened. On 10th October, this opened at 391, made a high at 394. On 11th October, it made a high of 958. So those who have written in the 300 range, they need to see that next day their option price goes up to 900. And let me tell you one thing, when an option position starts to move against you, the first thing that grips you is fear, and you just don't know what to do. Now think about the trader who wrote at 400, exited at 900, and next day he's again seeing his option trading at the 10th October level. What happens to him psychologically? Just think about that. And then 2 days before expiry, you see that the option is trading somewhere around 50. Now look what happens on the option expiry day. The option opens at 6 and the closing price that you see is 57. Again, when you see a single digit option, the thing is that people encourage you to write this option because hypothetically it's heading to 0. But look what happened on this expiry day. This option opened at 6, it went as high as 140. Just calculate or just think about the person who has written at 7, 8, 10. He's seeing the position rise against him by 10 to 14 times. And one thing I'll tell you, if you have looked at an option chart for a weekly option, it does not rise slowly. Once the position starts going against you, this 10 becomes 20, 60, 80, 100, 120 in no matter of time. You just won't be able to exit. So if you are among those rare breed of traders who can open up a position at 400, see it go to 1000, and then see it collapse to 1 and then rise to 140, then it's suitable for you. But if you do not have that skill set, again, please think before writing an option. I'll bring you to one more example. This is of monthly option, that is for Nifty in September. Now 11,300 put. Again, I saw this option, that is why I picked out this example. It started at 29, it ended at 319, more than 10 times high. This is for an instrument which is supposedly less volatile, which is supposed to move less, which is supposed to it's not that volatile because of the various constituents it has, both of high beta and defensive space. But again, if you write this instrument and see it go to 200, which happens quite frequently, I know some of you might be questioning that why should I hold a position from 30 to 200? Well, the fear concept that I explained you earlier, that is what happens. When you're writing and you see you're losing money, you tend to get in a situation where you want to hope that this position turns into profit, and this is what actually keeps you holding on to this position, and eventually the losses mount. Another example that I'll pull out is for monthly option Bank Nifty. So this is 27,500 put option for September. It opened at 141 and it made a high of 2,400. Just do the math here. Yes, you may not ride it from 200, let's say, to 2,400. You might exit somewhere at 600 or 700 or 1,000 or even 400. But the point I am trying to make is that when you're short selling something, the maximum reward that you can get is 100%. Right? But the maximum loss that you can make is easily 400%, 700%, 1,000, 2,000%. There is no ceiling to that. And don't underestimate the kind of events that can play out. You just don't know. Look at 2008, 2011, 2013, 2015, even 2018. There are lots of traders who have lost their entire trading account because they did not understand how to ride naked options without the underlying understanding the underlying risk. So one more time, I'll tell you, if you want to write options, please do so, but please understand the risk. The reason why I haven't given out a strategy this week and made this as a warning video is because I see even on YouTube, even on various websites, this whole notion that this can be done so easily. I am not that skillful who can do it, but I'll be brutally honest to you that before trying to calculate what profit you can make, please take a look at the risk profile chart of the strategy and see what you are going to execute. Now I'll again pull up this chart that I showed you. This is a very famous option chart because this forms the basis of writing naked options and how a bright future of writing options and making easy money exists in the market. Now, next time someone shows you this chart, that is the impact of theta and option price, and the option price goes towards zero, ask them to show you this chart as well. Now, this is the same chart with the option price plotted. Now, what this chart tells you, or rather this chart tells you, is that yes, over a period of time, option value decreases and it goes towards zero. What this chart does not tell you is that as option is moving towards zero, at times these events happen when option moves from 40 to 150, or it even moves from 4 to 300. So next time you hear all this, please take a snapshot of this and remind yourself of what you are getting into. Maybe a stage might come in market where you get so skillful that writing option becomes natural to you and you find out a strategy how to do it, but please consider the risk. So there are some common mistakes that I wanted to point out. Number one is this whole notion of thinking that option writing as a monthly income source exists out there. Well, it exists. Let me tell you, I won't tell you it does not exist, but it exists for the elite 1 or 2% people who can do it. Not for the remaining 98% people. There are many other strategies that exist where you can make money. Something as simple as mutual fund investing or picking out decent stocks to invest would give you much higher returns than a strategy which is completely skewed against you. Another thing that I see is people who give option tips. Now, they run subscription models where they'll come and tell you write options for unlimited income. Let me tell you something, no person in this world other than you can understand your risk profile better. So please don't give your trading account's future into hand of someone who does not understand you. Right? And next time an option tip seller tells you that you must write this option or that option, please ask him for a risk profile chart and let us see whether he knows what he's getting into. So one more important point that I want to emphasize is, despite of all this, if you think what I'm saying is not true and you still want to go and write options, please stay away from weekly call options and put options. You just cannot imagine the kind of losses that you can take. And second, please don't leave those positions unattended. A lot can go wrong even in 10 minutes. Let me tell you that. So I'll just summarize this week's video. The key message from me in this video is, without knowing the risk, please do not get into the business of writing naked options, whether it is call option or put option. Again, I would urge you to avoid the trap that goes around the options, naked options writing business. Please avoid doing it. There are just a select elite 1% people who do this very successfully. And I will tell you very clearly, I am not among them. I cannot do this. I am a very simple trader who understands very simple things. And that is my whole idea of this YouTube channel, that I want to put forward very simple things that people like me can understand and execute on their own. And one of the basic things that I understood in my life was basic mathematics. I want to focus on limited risk and theoretically unlimited reward. I don't want to focus on theoretically unlimited loss and limited reward. I hope my point is clear in this subject. So there are many other option strategies, including many I will cover. There are many other strategies that I've put out which are very easy to execute with limited risk. So please focus on that. I hope I haven't discouraged anyone here from following this particular strategy of writing options. What I've shown you is the dark side of options writing, which usually does not come out that easily. If you meet a very successful trader in your life, a person who's very successful in markets for over 15, 20 years, he'll probably tell you the same thing, that get away from the business of writing options. Instead, focus on many stress-free strategies that exists out there. The kind of stress that you're put on in your life just by writing options, you have no idea about it. So that's all for this week. I hope I haven't scared anyone. I just want to make you aware of the other side of options writing. In case you have any doubt about what I've shown you, do leave a comment below and I'll get back to you as soon as possible. So thanks a lot for watching this video. Have a great weekend and be safe, guys.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.